Good evening, good evening. Good to see everybody. Welcome, welcome. You should see the screen, should hear my voice. Interesting market today. In line with expectations, I would say, as of now. We're going to give it just a minute or so to let any stragglers get in. Make sure everybody's audio is turned on. Let me know if there's any issues on your end. And then we will get cracking. So, no problem, Stephen. We'll take that as an indication I need to be more clear with the schedule around the holidays. Maybe post it in a separate email. Recordings available certainly for you to peruse. All right, let's get cracking. Officially welcome out to the Market Watch Group Trading Foundations course. We are on to risk management. And technically in my outline, I have risk management for both today and Thursday, but there's obviously very different components. And in this first session here on risk management, we're going to go through some key concepts. You'll see the agenda here in just a minute. The one on Thursday, we're going to discuss trades in stages. So we're going to talk about 4 stages of a trade, the characteristics of each stage, and how our risk management perspective and thought process should shift. I'll tell you right now, one of the things that I looked for in my own trading was some type of a formulaic approach to risk. And I realized you couldn't have that. There is no formulaic approach because each stage requires a different thought process. And so this allows me to be a little bit more dynamic and fluid with what am I looking for? What am I willing to accept? What are my concerns? How do I adjust and adapt risk? So that's stages of a trade. That'll be next week. The discourse scheduled too. Yes. So discourse is going to, again, be playing a more prominent role. We will be launching next week. I'll send a few test messages to make sure everybody's getting it, but alerts will be coming via Discord. If you want to receive alerts, get on Discord. That's where they're going to come. So if you want them real time, make sure that Discord is giving you notifications to say, oh, you got a message, because that's where it's going to come through. I think you can set it so that it only flags, messages from the admin, from me, versus if anybody, there's definitely some customization to that. But if you haven't got on there, get on there. I still show up on Thursday mornings. I'm going to try to get Gary here on Tuesday mornings. And that way, and maybe even Friday, we'll see. And Gary will be joining us probably Tuesday of next week, I believe. One of next week's presentations, Gary will come and join us for that and give that. And he will start joining the Discord, and he will be participating in helping to create the alerts. Okay. I will, sorry, I have not yet. Stephen asked if I got the recording situation. I'll get those links though. And I'll post the links in Discord. That'll make it nice and easy. So they'll be sitting in there. And then I'll resend the email as well. So I'll make sure to get that out 2 different ways. Today, we're talking risk management. My name is Scott. Let's get going. Here are the disclaimers. Don't forget, this is educational and illustrative only. We're not advisors. This is not based on your specific financial situation. Agenda. Let's get the philosophy right. Like always, I always want to start with philosophy. What's our mindset for this? Let's go into it with a very specific, a very deliberate objective. Understanding the importance of risk management, the role it plays, makes it that much easier for us to want. We have to want discipline, not need it. If we need it, we're going to make mistakes. When we develop that desire for discipline, it makes it much easier. We're going to establish your risk tolerance if you haven't already. What's the most you're willing to lose on any given trade? That's a great place to start, right? And that will work its way backwards to help you develop your trade risk. And then your position sizing strategies will be based off of that baseline number. That's worst case scenario. There may be some strategies that you think, oh, I trade this more frequently, I'm going to cut that in half. I'm not willing to take maximum risk. I'm only going to take half. That's the great thing about risk management, is we can be as granular as we would like. Definitely the devil's in the details. So when you're drafting your rules, get to the details. Really think about each style of trade, each market condition, etc. Well, think about portfolio heat and the adjustments, meaning how much are you willing to risk at any given time? And is it more in a market that you identify as a 6 or a 5 versus a 1 or a 2? Is it more when the number's getting bigger, less when the number's getting smaller? You can see that we try to be somewhat fluid with correlating our overall portfolio risk with the conditions of the market, so that in a better market, we trade a little more actively. In a worse market, when we say, hey, wait, I've got 2 weeks in a row with a decline in posture. I've got a cyclical market in the second half of January that has tendencies to consolidate. Okay, well, if that's the case, we certainly have cause to reduce risk, to take a hedge, even if a true hedge signal wasn't triggered, right? An automatic hedge signal didn't trigger. Was there cause to take a hedge if you were carrying enough bullish trades? Yeah, absolutely, yes. Still cause to hold on to it. We don't know if we're out of the woods yet. It's an indecision day, but it was down. Yeah, we've got interesting things developing right now. Is there going to be a trade window that develops this week? Is it going to materialize? That's what we're waiting for. Patience. Patience is the name of the game. Stop loss orders. What role they play in how you control risk? Take profit orders. It's not just when we talk about risk and we talk about the characteristics. I want to be able to define risk first and foremost on every given trade. I have to define it. Where am I wrong? That's the first question. If you don't know where you're wrong, you don't know where you're exiting the trade. If you don't know where you're exiting the trade, you don't know how much risk you're taking. It's that simple. So we start with define the risk. Then we move to control the risk. That's where we position size and we say, all right, based on the fact that I'm going to lose X amount, I've translated that into a per contract. I'm going to do 3 contracts. And you can see we're very specific. We include time. Time's working against you. So you better work your way out 5 or 6 or 7 days. What's interesting is if I do a credit spread, I'd look at it differently. I look at a credit spread like not what if I'm wrong 8 days from now. I look at what if I'm wrong tomorrow, because on a credit spread, I'm getting positive time decay. So worst case scenario is if I'm wrong immediately. If I'm wrong a week from now, my loss will be less because I will have positive time decay working in my favor. And I might also make an adjustment to the stop loss or the exit point on the trade. So those things are organically reducing risk. When I quantify risk, I always want to think worst case scenario. Buying an option, worst case scenario is 8 days from now, 9 days from now, not tomorrow. If you stop out tomorrow, great. Less theta, less loss. It's the exact opposite. So these are the things that help me to be able to quantify, right? We have to quantify the risk and say, now that we've defined it and controlled it, we quantify it with a number and a position size. What's the last thing we have to do? Justify. You have to justify your risk. Now in order to justify it, I know what the risk is. I need to know what the reward is in order to produce a reward to risk ratio. If I'm risking 1 to make 1, no, not for me. 2, maybe. Now you're hitting the threshold. 2.5, yes. What's the objective? 3. That's my objective. So you'll notice that I have, borderline, acceptable, desirable. There's no just set number. It depends. If I know I need a trade in a certain sector, or I want to trade in a certain sector, and I know I have a limited window, and I say, oh man, this is the best I'm getting, 2.6. But 2.6 it is. I'd rather get 3. Now, if I get 3 trades that show up, I'm going to take the highest, and I hope it's over 3 because I'll probably only take 1 trade. So you'll notice that the way I'm allocating risk is I'm definitely looking at the sectors and making sure that I'm not overweight. If I have 4 financial stocks, they're all likely to go up and down the same way. There may be a slight non-correlation, but for the most part, they're going to move lockstep. Sectors move together. That just is what it is. So I want to know what my take profit order is, how it creates a reward, what that reward is to my risk. We want to run through a quick position sizing example, and then we're going to talk about the components of a risk management plan. We are actually, fortuitously, working on risk management, not this week, but next. So it'll be pretty fresh. We'll cover risk management today, stages of a trade Thursday. Then on Sunday, we'll switch gears in our group setting and start working on section 4, risk management. This is a perfect primer for it. It's almost as if I planned it that way. Okay, let's get into it. The importance of risk management. Number 1, protect your capital and reduce potential losses. I've told this story many, many times, but a long time ago now, I had one of my favorite jobs, and that was teaching a boot camp. I worked with great instructors. We were up at this very fancy, nice hotel, great rooms. My kids were young. They could come up and stay and hang out and play in the hot tub and playground. It was just great. There'd be 15, 20 people, 3 instructors. We'd lock ourselves in a room for 3 straight days, and we would cover an entire program. And I did that class for just about 4 years. And it was very much a laboratory for me. I was on a big psychology pursuit. So a lot of the trading psychology principles I put to the test in this setting, because I could really get an understanding of how people, how their psychology correlated to what they were doing. So an amazing time. One of the things that I liked was interacting with different people. And one of the people that I interacted with that came through was a grand master chess player. So he had attained a lucrative title of grand. I can't remember his name. I'd have to really. This was probably 2005. So going on 19 years now. But it was interesting because I said, okay, philosophy. What's your thought process? I'm thinking, right? We're always trying to be proactive. I love chess player analogies. You're always trying to be proactive. 3 moves ahead, 4 moves ahead. So my thought was, he's thinking 6 moves ahead, 7 moves ahead, right? But it surprised me. But it was, what an amazing answer. And it's shaped the way I've traded for these last 19 years. But when I said, what's your most important consideration? What's your objective? It was not think 6 moves ahead of my opponent. Gave me 3 words: protect the king. That's it. He said, if I don't lose, if I never lose, if I never leave myself open to lose, then I can implement my strategy to win. Brilliant. That's our thought process here. Protect the king at all times. That's your thought process. If I don't lose money, it's much easier to go out and make money. That's our philosophy. We want to maintain a disciplined approach to trading, investing. And like I said, it's not I have to, it's that I want to. I want to hold my discipline in order to let the core objectives and the core values and principles in our trading plan take place. We can't lose our minds and let the chimp start smashing the keyboard and then be like, oh, what happened? We know what happened. It enhances long-term profitability by effectively managing risk every day. First thought I have is, how do I better manage my risk today? How do I better manage my risk today? That's it. Constant improvement. Managing risk is the best way to manage your psychology. When you know that your risk is under control, when you know that even if things really turn ugly on us, well, number 1, we know that we're likely to see it, or at least some evidence of it. We've demonstrated that, right? Nothing has ever snuck up on us. We've seen things coming. We have a tendency to get hedges in place. We should feel pretty comfortable about that. We should feel comfortable that our risk is controlled according to market conditions, that we have fail-safe mechanisms that kick into place when conditions start to get bad. If I can manage my risk well, I'm not going to panic. I'm going to let the process prevail. That's why we're doing this. That's the importance of this plan, or this component of the plan. Establishing risk tolerance. First thing you got to do, define your comfort level with risk, meaning what is the worst case scenario I'm willing to take on any given trade? And then you work backwards from there. If I have a $20,000 account, I might say 2%, $400. Okay. So maybe if I'm in ideal conditions and I'm doing my favorite trade, swing trades, 2%. If I'm doing any other kinds of trades, I might go down to 1.5 or 1%. If I'm day trading, I might do 0.5%. We have some flexibility. It needs to be consistent by system, whatever the rule is. If you're swing trading, all your swing trades, same risk. If you're day trading, all your day trading, same risk. If you're taking trades from a newsletter, from a service, all those trades, same risk. Each system has its own level of risk, but they all should be the same. Psychology improves with higher balances and lower losses. Bob said, great comment, right? I agree. Make sure that you're considering your goals, your investment horizon when you're thinking about your risk tolerance. Also be thinking about what is the percentage of your portfolio you're willing to risk at any given time. So both trade risk and account risk, we need to be thinking at it both levels. That's that final bullet point. So when you're done, you should have worst case max loss scenarios. Trade risk maybe is 2%, let's say. Smaller account, it might be 3 to 5% even. I would really caution against ever going above 5%. I would caution against 3%. If your account's 5,000 or more, I would say 3% should be enough. 5%, it can really hit you with some drawdowns if you catch 2 or 3 losers in a row. And that's psychologically debilitating. And part of our objective here is to control our psychology by controlling our risk. So the other thing is, what's your portfolio risk? So if you're doing 3%, you might say, you know what, 5 trades maximum, 15%. And that's only in the best conditions, which means if you're not in the best, you might only have 3 trades going on simultaneously, 2 trades, because we definitely want to make sure that our risk is controlled from a total perspective and on an individual perspective. Okay, that's our tolerance levels. That's going to help us to then work our way backwards to figure out the number of trades, the risk per trade, what is the right balance, how are those numbers going to shift as market conditions change. So now we start working with those risk levels to determine position sizing strategies. Now, questions as we go. If you have a question, spit it at me. I'll get to it. I'll try to get it in the flow, but give me questions as we go. And comments are fine as well. 1 to 2%, Bob said, yeah, that's very common, right? That 1 to 3 is probably the most common. If someone's trading over 100 grand, I'd probably say start with 0.5%. That's $500 of risk. You might lose that in 2 days. So you might think, oh, it's only 0.5%. But then when you take a $500 loss after a trade stops you out in 2 days, you might be like, oh, that kind of hurt. So, sometimes it's good to acclimate ourselves. One of the biggest problems I've seen in trading is when people go from paper trading to 2% risk. No risk, 2%. I always say it's a good idea to acclimate and say, you know what, let's go 1% for the first 20 trades and then look at the numbers, maybe 25. Give yourself an entire column on the record keeping sheet. And after the first 25, as long as your expectancy is positive, maybe even if it was break even and you thought, you know what, I got hit by some slippage, mostly I would want to see it positive. Then I'd say, okay, let's go ahead and raise the risk now. Anytime you're thinking of raising your risk, you got to have the data to back it up. You got to have a positive expectancy that says, yeah, you know what? You can go ahead and take more risk. Our spreadsheet is built to help us understand when we are in that situation. It helps us to avoid ever committing too much capital on a single trade. Oh, that can be dangerous, right? And it's always like, oh, I had a great feeling about that one. I read some news and it made me really excited and I bought more. The market was waiting for you to buy more. watching, waiting, ready to punish us for those mistakes. Can't do it. No more. We want to make sure we achieve balance between risk and potential reward. That is where we are justifying the risk of a trade. We're defining it through our risk tolerance, through position sizing, through establishing these parameters. As we define it and quantify it, we've got to justify it. We got to make sure that does the end game provide sufficient reward relative to the risk that you're taking. All right. And remember that we cannot determine position size without understanding and defining risk. We cannot define risk without knowing exactly where I'm wrong. That doesn't mean you have to set a hard stop. It could be mental, but you better be good at getting out at or near wherever you define. Because if you say, oh, I'm stopping out at 72, and then it hits 72 and you're like, well, and all of a sudden you get out at 69, that $3 extra times 100 shares, that's an extra $300 of loss. So if you were wanting to keep your loss at 400 and now it's 700, that's not going to look good on your spreadsheet, right? We have mechanisms built into the spreadsheet to help us assess how well we're containing our risk. You actually have a risk to, or a realized risk to willing risk ratio that helps you to see if you're keeping your losses small. It's a great mechanism built into the spreadsheet. Portfolio heat and adjustments. Remember that your portfolio heat refers to the level of risk or volatility associated with your entire portfolio, indicating the potential for fluctuations in its value. If I have 7 trades and they each have 3% risk, I am 21% portfolio heat, 21%. Now, let's say that there was a gap and it actually got even worse. I went from 21 to 28, 30. That's catastrophic, right? That's catastrophic. If you lose 10%, you have to make 11% to get back to break even, right? So if I have 100 grand and I lose 10 grand, 90, if I make 10%, I'm at 99. I didn't get there. I need to make 11% to get back. If I lose 20, I have to make 25. If I lose 40, I have to make 66. If I lose 50, I have to make 100. Do you see how it gets worse? Losing money has exponential consequences. So if we can keep our losses in that 5 to 10% range, no more than 12, then we're in a position where we barely have to make more than we lost to get back where we started. And we can achieve that with positive reward to risk ratios, keeping us in the game. You always have to live to trade another day. So that's what we're thinking about with portfolio heat. It should be directly correlated to market conditions. If you're ever going to put yourself at maximum heat, the question is why? Because I have optimum conditions. I have a great VIX. I have great trends in place, both long and short term. I have a broad-based rally with 5 sectors participating. I have, the NASDAQ and the Russell leading, and I have all these characteristics. Interest rates are, the Fed is on my side and employment is good. That's what gets you at a 6, a 6.5, a 7. Not even, I mean, we maybe get to a 7 at some point, but if we hit those levels, yeah, I want to trade as hard as I can for as long as it lasts, knowing that at any time it could reverse, which is why we're always looking for the other side. We do not trade complacently. And don't forget, one of our big practices that is a large part of our risk management structure is to hedge. We look to get hedge signals directly from the VIX, hedge signals that might come from sector rotation. One of the things we watch for, even when things look pretty good, is do we see defensive surges occurring in utilities or in consumer staples? When we don't see those defensive surges, we feel like, okay, we're okay here. Well, we might see a little diminishment, but nothing that tells us, oh, wait a second, this thing is reversing pretty quickly. Okay. Stop loss orders. How do they play into what we're doing? We implement stop losses to limit losses. That's their job. I love a good hard. I love when I have a physical stop loss in place, a hard stop. That physical stop means that if intraday I'm not watching and it triggers, if it blasts past a price level, it's going to happen automatically. I will not look to have orders, stop orders execute in the first 20 minutes of the day. In that first 20 minutes, if I had a stop that looked like it was going to trigger, I would pull it off, wait for the market to establish itself. And then if I want to put it back on or even put it in a slightly lower place to allow it to try to recover, great. But I do. Now, if you're going to use mental stops, that's fine. Make sure you're making really good use of alerts and setting your alerts before your mental trigger. If you're saying, oh, I'm going to get out at 72, don't set an alert at 72. Set an alert at 72.50 so that as it crosses, you're starting to say, all right, let's watch a couple of things and see, do I need to shut it immediately when it gets there, or am I going to give it a little bit of time? Bob said, I thought you prefer mental stops. I use hard. No, I'm going to use a good mix of both, but I like hard stops. Anything I can automate takes human error out of the equation, and I would prefer that. We set predetermined price levels to exit losing positions and prevents emotions from driving trading decisions. Stop losses is a great place. The chimp is always lurking right behind you when you're placing a stop, right? It's like, oh, don't let it stop you out. It's going to stop you out. Immediately turn around and come back. Just take, right? The chimp is trying to convince you. So develop some hard and fast rules for how you're going to use them and how you're going to decide, is it time to lock it in and let the order itself prevail? Stop losses, or at least a mental stop, is how we define risk for position sizing. So every trade has to start with at least some level of, this is where I'm wrong. This is my line in the sand. If you want it to be intraday and it's going to be a hard stop, if you want it to be end of day and it's got to close through, end of day puts you more at risk. That by the end of the day, it's actually dropped much worse. And all of a sudden your risk has magnified. So, but it won't take many of those to convince you to use a different model to change it. Sometimes you just have to experiment to see, like, oh, you know what? I don't like that. Maybe you decide you do. All right. Take profit orders. So we've addressed the risk side. You have to always take into account the profit side. You have to have a target. If you're right, where's it going to get to? I want to be reasonable, but I definitely want to still have a certain level of ambition. I don't want to be like, oh, if it gets to the old high, if it gets to its old high, you're maybe going to get 2-to-1. Like, that's where I want to be like, hey, you know what? If it gets to the old high, I'm going to sell a quarter or a third, lock some gain in. I'll get 2-to-1. I'll tighten my stop to a little above break even, give it some room, and then see if I can go get 3-to-1 on everything that's left. That's the type of plan that I'm looking for. So it's okay for us to have some take profit orders, but we better have a sense of how much, when, and then what do we do to then minimize ongoing risk. But we really want to have a clear sense of, where am I looking to exit winning trades? I'm going to have a level where I think I can relieve some pressure here, but my ultimate goal is up here. Great. Hopefully I'm getting 2-to-1 on the first, 3-to-1 on the second. I will love that trade every time. That gets us in a situation to lock some gains in when they're favorable based on market conditions. Here's the thing. It never looks like it's going to fall apart. If it does, you wouldn't hesitate. We have to just assume that sometimes it's going to fall apart, and that's why we take some pressure out of the trade by locking some gains in at a good point, taking some risk out of the rest, and then it's much easier to great, let it run. Get 3-to-1. Put on a trail stop and try to get 4-to-1. I am all for it at that point. It's easier to let profits run when you have yourself in that type of a reward to risk scenario. These take profit levels should be determined in your initial analysis. So as we think about our initial analysis, The levels we're thinking about are, do I have the risk, excuse me, do I have the reward to justify the risk? That level's already in place, right? That level's already in place. Okay, let's pause for just a second. Any questions? Okay, we're flying. Looking good. Here's the scenario. Somebody has total trading capital, $10,000. And they are going to buy shares of company X. I can't use this as an example anymore now that Twitter has decided to call themselves X. I don't mean Twitter, which is currently trading. They don't publicly trade anymore anyways, no options. So the scenario is I have $10,000 in my account. Company X is trading at $50 a share. We are looking at a maximum of 2% trade risk on this trade. So let's kind of walk through the calculations. And then I'm going to talk about what would it look like if I were actually thinking about the options trade. And there's a couple of different scenarios for that. So first off, we need trade risk. 2% of 10,000. 0.02 times $10,000 equals $200. $200. So obviously if I had 3%, it would be 300. 1%, 100. I'll tell you right now, 100 to 150 is a tight spot. It's with stock, you can do it. With options, you're going to find it hard to control your risk between 100 to 150. It's easier around the $200 level. So if I have $5,000, 3% puts me at 150. That's going to be the lowest I would go. Anything below that, you see it have to kind of force you to increase your risk level. But in this case, 10,000, 2%, $200 risk per trade. You could go maybe as low as 1.5%, but any lower than that, you're going to find that you really are losing control with options trades. It's hard to be consistent. Okay, now we decided we're going to buy it at 50. We're going to set a stop loss 1% below the lowest point. The lowest point was 48.50, so 1% below, 50 cents below, puts us at 48. That's our stop. So our entry price is 50, our stop loss is 48. The difference is $2 risk per share. So now I have $200 trade risk. I have $2 risk per share. The only way for me to do position sizing is to have both. How much am I willing to risk as a dollar amount? That's 2% of my overall account. How much am I risking on this trade per share? That is the entry price minus the stop price, $2. Now I take trade risk divided by risk per share. $200 divided by $2 per share equals 100 shares. All right, 100 shares. So if I buy 100 shares now, if I buy 100 shares of a $50 stock, that's $5,000. That's half of my account. And that is why we need options. We need leverage as swing traders because you could go on margin and maybe get 4 trades on. 4 trades, 2% risk per trade, 8% risk. You're not going to get 12% heat if you wanted to really extend your account. The only way that you're going to swing trade and get your trade risk into that 10 to 12, maybe even 15% level is with options. So it's not that I want the leverage. I actually need the leverage. I'm not trying to take more risk. I'm just trying to get more trades on the table using options. So if I were to do an options trade, I'm going to be taking this and it's going to be turned into contracts. So instead of buying the stock at $50, I might buy call options at $50. Now, if I buy a $50 call, it's right at the money. Right at the money. So let's say I pay $2 for those options. And at the money delta is 0.5. So that $2 option, if If the stock drops by 2, I'm going to lose $1 on my option. That's what that 50 delta tells me. Okay, so if I'm losing $1 per contract, that's $100. That would mean I do 2 contracts. 2 contracts at a delta of 50. People might think, wait a second, a contract controls 100 shares. No, a contract controls 100 shares with a delta of 0.5. Multiply 100 times 0.5, it's 50. So if I buy 2 contracts with a delta of 0.5, that gives me a delta of 100. That's just like 100 shares. You'll notice those 2 positions are actually the same. They both control 100 shares. Although one of them I can do it for $400. The other one costs me $5,000. So the leverage, getting 12-to-1 leverage. Great. That's why I like the options, because now I could have 5 or 6 trades on, and I would still have capital if I needed to get another trade. So risk management isn't just like, hey, it's really good if you control your risk. If I'm looking at this like a business, I have to know, how am I going to make sure that when I have optimum conditions, I'm able to get my account working for me at the rate that I want to? Because if you're trading stock only, you're going to have a hard time doing that. You won't be able to. You'll run out, even if you use margin. And if you use margin, you're borrowing and you're paying your broker for that loan. Okay, so that is position sizing. That's how I would end up with 100 shares. If I turn that into an option, I could end up with 2 contracts that behaves like 100 shares. If I did a spread trade, I would have to build the spread. Then I would have to look at how much would I lose if the stock drops from 50 to 48. Remember, 50 to 48 is where I'm wrong. No matter what, if I buy the stock, if I buy an in-the-money option, if I buy an out-of-the-money option, if I buy a bull call spread, I get in at 50, I'm wrong at 48. So I need to take that trade, whatever it is I'm considering, and I need to figure out how much am I going to lose if it drops to 48. Then I can say, great, I'm losing $200 on this spread. 200, that's all I'm willing to lose. 1 contract. That's my position size. That's how I am adhering to and maintaining discipline to the position sizing and the risk management rules that we're talking about getting into place here. That's position sizing. Considering a stock, how would we then translate that into an option? What would it look like if we decided to do a diagonal spread or if a bull call spread? We have the ability to put on any of these different types of trades. We just have to go in. We go into our analyze pricing model. We add simulated trade. We build the trade we're thinking about. Then we say, now what would that trade look like if it dropped to 48? And then we say, great, now we have defined the risk. Now let's control it and quantify it and put an exact number on it and make sure that number is in our wheelhouse for what we're willing to lose. Okay, here are the components that you're going to be defining in section 4 of your trading plan as you build your risk management plan. Number 1, portfolio heat. What's the most you're willing to have at risk at any given time? So the consideration there is, if this was the best market you can think of, what would you be comfortable? What's the limit? You got to have a limit. We need to have trade risk. That's the most you're willing to lose on any given trade. And that's the best trade you can think of. And then you work backwards from there. If it's a trade that is not as common, if it's a trade that you don't have as much numbers for, you might dial the risk back. What is the most? And then you work your way backwards. We need to make sure with the number of concurrent trades, and you can go with average or you can go with max. Initially, I would say you go with average. What's the average number of trades? If I say I'm willing to have 12% risk and I have 5 trades on at any given time, I take 12% divided by 5, 2.2%. Great. 2.2. So if I had a $10,000 account, instead of doing 200 risk, I'd do 220. Is that a feasible plan? Yeah, I love that plan. Are you always going to be right at 220? No. But you got to start with something that's a great way to go. There's got to be balance. As you change, do you change number of trades? Do you change risk per trade? Do you change both? How are we looking to dial back risk when we see conditions start to deteriorate? You have to have a plan for that. Don't think, oh, I'll just make it up as I go. Shoot from the hip. Great. Just bring the monkey out, sit him on your lap, and let him start banging on the computer if you shoot from the hip. What are your risk adjustments? What about your market posture will cause you to take different levels of risk, will cause you to hedge? We have some things that are market posture oriented. We have some signals that are developed specifically from a certain combination of events, a higher low on the VIX, or a defensive surge in our sector rotation. Either of those could trigger automatic hedges. But what will cause you to risk? If you see 3 weeks in a row, if you see a 2-point drop, if you see a above 5 market drop below 4.5, what's going to cause you to do that? Okay. Now, you need to be thinking about your tsunami indicators. I've already defined 2 of them. What was the first one? Higher low on the VIX, tsunami indicator. What's the tsunami? I'm worried that volatility is escalating and that it's going to start smashing higher because that's how volatility works. Another tsunami indicator is defensiveness in the market. Most commonly, we're going to see it from the sectors where we see all of a sudden some surges in defensive sectors like utilities and consumer staples. We might also see a significant sell-off on the Russell combined with a surge from the Dow. That would be a defensive shift that would have me scratching my head and thinking about a hedge as well. Any of those could indicate market weakness. Be thinking about the tsunami indicators. Be thinking about those different types of things. Question: you are talking about taking 12 trades. Are you only looking at 1 contract per trade? Or does it matter how many contracts you have per trade? No. I mean, I'm not sure what your 1 contract. I'm looking at 12 trades with 1% risk per trade. That's 12% portfolio heat. If your portfolio heat, and if you ever wonder where that comes from, it's the Kelly criterion on our spreadsheet. Kelly criterion. So if you look at, oh, I don't have it. Let me pull it up real fast here. If you look at, open a new window, market watch. Here's our option log, yeah? So I don't know how many contracts you'll have. That's based on your own position sizing formula of trade risk versus loss if you're wrong. Here you'll notice that I have a Kelly criterion. Kelly criterion is a risk optimization formula. My basic premise would be to take 80% of it. So let's say my Kelly was 20%. My actual Kelly implementation would be 16% Kelly. For me, that is my maximum risk level. When conditions are their best, I'm willing to have up to 16% risk. So if I have 2% per trade, that's only 8 trades, not 12, only 8. 8 trades, 2% risk. 2% could be anywhere from 2 contracts to 20 contracts, depending on how big somebody's account was. So it's very hard to try to quantify rules by number of contracts. That's why everything we do is based on percentages, right? What is your percentage that leads you to your trade risk level? That's the number that's going to determine your number of contracts. So that very much is dependent upon risk tolerance and size of account. No, not remember that what I said was Kelly, take 80% of Kelly, 80% of Kelly, not a Kelly of 80%. So a Kelly's going to be anywhere from probably 10 to 20%, and that's only if you're profitable. If you're not profitable, if you don't have a positive expectancy, you're going to have a negative Kelly. Negative Kelly means don't take risk. How much risk should you take to optimize? 0 until you get a positive expectancy. Kelly is 46 right now, so that's very strong. Very strong. I would caution against ever going above 25% portfolio heat. But that gives you a lot of leeway to take risk. I love a strong Kelly like that. So I do still have those. We're gonna have to maybe even create a separate session maybe we'll do a working session just for spreadsheets. As I'm going through this, I could see the need for that. Okay. Now in addition to the tsunami indicators, we need to have a sense of when do I take a break. That's going to be considerations like a certain number of losers in a row, 5 losers in a row, 6 losers in a row, 8 losers in a row. Don't go 2 or 3. Come on, give it some room. A drawdown, 10% drawdown, 15% drawdown. Don't let it draw down more than that without taking a break. The third level might be just simply psychological. If you realize you're feeling impatient, anxious, you're just not trading your best, give yourself a quick 3-day break, right? Walk away from risk, but keep watching the market. You can't just sort of like, oh, I'm going to walk away and come back and the cards will be better. You got to still sit at the table to see how things are going. You just know you're not going to push to play for a little bit. And of course, you're hedging. All of these elements need to be defined. What is your heat? What is your risk? What is your number of trades you're willing to have or comfortable managing? How and when will you adjust risk? What are your tsunami indicators and what do they, what action should be taken when you see them? What are the factors that will lead you to take a break? What are your rules and implementations for hedging? You get that in place, you will have a very strong risk management plan. In summary, and throw any other questions you have. Risk management is essential for capital preservation, for safeguarding your financial well-being. Live to trade another day, never forget. Plays a pivotal role in ensuring long-term success, helping navigate market volatility. We get in our shell when conditions get ugly, and then we move back out when the sun starts shining again. Effective risk management promotes emotional control and discipline in your decisions, reducing impulsive actions during market fluctuations, making sure the chimp is in the cage when things start getting a little nasty, right? Okay. Yeah, you know what? That's a great idea, Steven. Let me think about when we could do. Maybe we'll do just like a one-time trade log. Maybe we'll take like a little break on a Sunday, take a 10-minute coffee break, and then do like a 50-minute session. So we may do like a 2-hour Sunday soon. Let me look at the best time to do something like that as a supplementary. It'd be great to have. Maybe I'll create like 6 sections and just do like 8 to 10 minutes per section. That way I can break it up into bite-sized video pieces and add it to the content library. Yes. Okay. All right. Well, what do you think? That's what is R to R? Reward to risk. Some people say risk to reward. I am reward to risk. 2 to 1, 3 to 1. Reward to risk, R to R ratio. So in your trade log, you're going to see empirically what is my average win size? What is my average loss size? What is my reward to risk? What is my expectancy? What is my Kelly? You can see your risk per trade. You can see your loss to risk ratio. This is where I have the ability to enter my beginning equity, my trade risk, so that I can have a sense of what my risk per trade should be for any given set of 25 trades. We'll talk about how you can utilize this to provide contextual info to give you a little bit more meaning when it comes to these columns. Got it. Steven's kind of dealing with the conversion between low dollar stocks with 500 to 1,000 shares versus losing a call option. So yeah, I like what you're looking at. You might just have different rules where you say, well, if I do call option, these are the rules. If I do stock, these are the rules. And look at them as different systems, and that you might have different levels of risk for one versus the other. Even though they're both bounce trades, implementing consistently different strategies does change the dynamic of a system. So yeah, one would be an option trade system, one would be stock system. All right. Any other questions before we wrap it up and close the door on our intro to risk? Sometimes the calls can definitely cost a lot. You're absolutely right. Even in times like now, when we have relatively low implied volatility. Okay. We will be meeting tomorrow for the midweek check-in. It's always a little funky when we have a Monday holiday and shortens our week, but we will be meeting tomorrow. Oh, Sandy, love that you showed up. I didn't see you earlier. Your one inch snow already melted. Oh man, I've got some of the biggest piles in the neighborhood. My piles on the side of my driveway are both probably 5 to 6 feet tall and just enormous. It was nasty. Thank you guys. I'll see you in the morning. I'll see you Thursday for stages of a trade. As always, happy trading.